On this episode of After Earnings, Ferrovial, the transportation infrastructure company that recently joined the Nasdaq 100 and helms projects from Spain to Texas. I'm joined by Ernesto López, Ferrovial CFO, to discuss the company's role in developing JFK's new international terminal, its expansion into data centers, and what private equity's increasing focus on infrastructure means for its business. Let's get into it. So, Ernesto, I grew up in London, so I'm pretty familiar with Ferrovial. It's a brand I recognize from all my time in Europe. But for those in the States, in the United States, who perhaps aren't as familiar, just give us in layman's terms, the kinds of products that the company is offering.
Okay, so basically the company has infrastructure assets, right, that are used by everybody, right? So we have highways in the US, and they are in urban areas, so they are super helpful to avoid traffic jams. And we have them in Dallas, Fort Worth, Charlotte, Virginia, close to Washington, right? And of course also in Toronto, in Canada, right? So that's where most of the value of the company lies, right? We also have airports.
Yes,
right? So
airports.
We used to operate Heathrow at the time.
I remember, yeah.
Now we are developing the new Terminal One at JFK, right? So that should open in the coming months, maybe end of the year, and it should provide a different experience to international travel.
And how different? When you say it should be different, in what way?
Well, more ease of travel, right? People hate just spending time getting out when they arrive. That should be easier. Also, there should be a better commercial offering, better lounges. So for international travelers, it should be, let's say, a better product.
So I just want to really dig into that a bit, because it's one skill to build highways, right? It's a different skill to build a building of the commercial size and impact that that an airport's going to have. So is your company literally involved in trying to design like optimal people flows through the terminal? How much is that design work done by your company as opposed to just the construction and that part of it itself?
Okay, actually, yes, in NTO, we are not doing the construction. We usually do the construction and we do the engineering, right, the design. Here for an airport that is quite complex, yes, we have architects that work on that. We help also on the efficiency of the design in terms of energy consumption and also layout, right? So we work with all these architects to try to get something that is very convenient for passengers and at the same time appealing, right? So you will have a very wide commercial offering, and that the Port Authority has been very keen on getting that. And it should be, as I said, easier to go through.
So let's take the Terminal 1 at JFK as just one example to really sort of dig into the economics of the business. Talk us through how that opportunity came about.
Well, basically, the development of an infrastructure like that is very complex because you need to navigate a construction company with a lot of parties involved. From systems to energy to baggage handlers and all the infrastructure that could be quite complex, right? So you need to be able to have a contract that is financeable. So we worked around that and got the financing with banks. Now it has been moving into capital markets, right? So it's all bond finance, let's say. And that also is combined with the economics with airlines, right? So there's always a ramp up that is risky because, there's, let's say, excess capacity now. But with all the projections that organizations like IATA and so predict, you should have a point where there's kind of capacity constraints, right? And there was you have a better pricing power. And
so in the case of the airport, you've raised financing.
Yes.
But who's ultimately paying? How much of this is public sector money and how much of it is private sector funding?
There's no public money. It's all private, right? So it's a mixture of, let's say, muni bonds and let's say private equity from institutional investors and us.
And in this case, who is the private equity partner?
We are the, let's say, infrastructure investor with an industrial background, right? We are not really a pure financial investor because we've operated airports like Heathrow and so on. So we have some industrial background that pure financial investors usually don't have.
So I love the way you just described that because infrastructure private equity funds have gotten bigger and bigger and bigger.
Yeah.
And how much are you competing against them where they perhaps want to be the primary or the anchor in this project and then go find an industrial partner versus are you able to step up and take these projects holistically?
Okay, the key difference is that when there's construction risk for a private equity is very complex. They usually don't have the engineering capabilities, they subcontract them. Yeah. And there's a misalignment of interests, right? And usually we do the construction and the investments, so we kind of align interests there, and that helps. And it's a little bit different because we're not doing the construction, we're running the PMO, right? But it's good to have all that knowledge to try and navigate that part. And that's where we differentiate from private equity. Otherwise, they can be just on pure financial return.
And so when you try and think about the returns that you're targeting, just to sort of go into the realm of the CFO, and how that's going to translate into return on equity for your shareholders, what are the returns that you're explicitly targeting on a project like this?
Okay, that is very commercially sensitive, right? Because we are competing against others.
But I had to ask, right? Yes.
You have to ask,
yes.
but it's a healthy return because we have to navigate through the construction risks, right? Once the construction and the ramp up is over, you get more into the typical infrastructure return that everybody could bet for, right? So for us, it's key that we handle the construction risk phase, let's say.
Let's talk about the airport you mentioned, London's Heathrow.
Yeah.
Early last year, Ferrovial sold its stake in the airport. Yeah. What drove that decision?
Well, basically, it's let's say an airport that has been de-risked from, let's say, operational construction point of view. It has a regulated return, right? So it's not that you negotiate with airlines. It's a regulator that says how much you can earn, right? So the regulator views the business as less risky and with a lower return, right? So it's a great asset for pension funds that want to beat the UK inflation, but for an operator like us that really makes the money in the development, and then operation, but we have to go through the development to make more of a return. It didn't fit into our portfolio, right? We prefer to, redeploy that capital with NTO or others.
We'll come back to use of proceeds and talk about your capital structure a little bit later. But let's shift gears and talk about other kinds of assets that Ferrovial is instrumental to. Let's talk about your highways, particularly here in the US. There's been a lot of conversation for years now about increased government spending on infrastructure. Yeah. Can you talk in tangible terms about how that's translated into more project opportunities for you?
Well, you really touched on our key selling point, right? For us to a grantor, we were saying, don't worry about this. You're worried because you need money to invest. You also are worried of overruns and delays, something that is very inconvenient. We will give you a package there where everything is sorted out, right? We take care of all the construction risk. We even pay an upfront ticket to you so you can use it for other things, hospitals, schools, whatever. And in exchange for that, we need a long-term contract where we have flexibility to price our, capacity. That is an added capacity to what you already have.
And the freedom to price, just to turn that into a tangible example, is tolls on highways, right? So
yeah.
That's sort of what we're talking about here. Express lanes in Texas, toll roads on the East Coast, almost 50% stake-ish in Canada's 407 ETR highway. When you think about the opportunities in the pipeline, Ernesto, are you seeing more in highways? Are you seeing more in airports? Or are you seeing more in other kinds of assets?
We see more in highways because there's a lot of congestion that is just the result of underinvestment for decades. So it's adding capacity at already existing roads. That's the good thing about it, right? Because you're basically improving everybody's lives, right? The people that don't want to use the toll section, in any case, have more capacity, less cars there, right? So you're providing a choice that is really valuable.
Growing a business has never been easy. If it were, spreadsheets would be optional and stress would be a hobby. Whether you're navigating a complex industry or actively trying to reinvent one, KeyBank brings a deep bench of banking experts who collaborate on market-proven solutions. They're not just here for the business you're running today, they're here for the one you're building toward next. Reimagine business as usual, KeyBank opens doors. Learn more at key.com/B2B. That's key.com/B2B. Well, we have to talk about AI infrastructure because you're such a big player in infrastructure generally, and all the chatter is about data center expansion. How much exposure does Ferrovial have to that area of development?
Okay, I mean, build data centers. We've done that for hyperscalers, and I guess that our edge is that we are good at doing things on budget and on time, something they appreciate because the speed is of the essence. From an investment point of view, it's limited for us. I mean, we are developing some plots, but there's nothing that we are looking of going big on investing here. Our preference now is the pipeline that we are getting on highways in the US, but in any case, we are investing a little bit.
And is that because the data center construction realm has just become a lot more competitive, and is that driving returns down, or is there some other reason that it's not as attractive as some of the other assets?
No, I mean, construction we do is fine, and in general, you see all the construction companies across the world are having kind of tailwinds because there's so much demand for infrastructure that they're doing good. So no, it's not about the complexities of construction. Just investing equity there is more kind of real estate. I mean, returns we think are better in highways.
And Ferrovial acquired PowerNet. How did that change your capabilities in that space?
Well, that was a very tiny acquisition, but it's good that they pick it up. I mean, a lot of you did your homework. It's very small. You just added, let's say, installation capabilities, right? So we are more into civil works. These guys are more into all the installations, hardware, utilities, this sort of thing.
Can we talk about another kind of competition, which is the sources of capital? And infrastructure private equity has really expanded as an asset class over time. Investors, particularly pension funds and institutions, like the steady state of the contractually based returns. How much are you competing with private equity funds to get any part of the project portfolio you've described?
Well, since we are focused really in developing and doing construction, they are not really competing with us there. I mean, they could come as partners, but not really competing because you need integrated players. You need someone that has a skin in the game in both areas, the construction part and the investment part, right? Otherwise, you don't align objectives and you could have a situation really trying to develop something.
And in terms of your global presence, you've described this enormous pipeline in the United States.
Yeah.
The company has European heritage, headquartered in Amsterdam. But when I think about really big construction projects and the headline-grabbing spend, it's the Middle East and it's parts of Asia. So how much exposure do you have to those geographies?
We are not exposed there. I mean, really, when we develop things, we try to be there for the long run, right? So we look not only to next project, but for decades long investment and to be established there. So I mean, the good thing is that in the US is where we have value and really most of our activity. In that part of the world, we've done things in Australia where we have some construction capabilities, but I mean, it's kind of a second tier country for us.
Let's talk about your recent earnings, Ernesto. Your fiscal year 2025 earnings were released, strong results. I have them up in front of me. When you take a look at the revenue increase, 8.6% like for like, adjusted EBITDA, I focus a lot on that, sort of vague proxy for underlying profitability, 12.2% rise year over year. What is driving this? Is this mix shift? Is this fundamental productivity improvements in the projects you've already got going? You're seeing outperformance. Just bring to life some of the reasons for this, strong set of operating results.
Basically, growth comes from the fact that we are providing a product that is really needed, right? I mean, all the areas where we have invested, congestion keeps increasing, be it Toronto, Dallas, Fort Worth, whatever. So we have the available capacity where you can travel fast and safe, right? And people just like that and use it more. Also, commercial activity is increasing when you have all these online commerce translates into delivery in the end, and this kind of users really appreciate the fact that you can travel fast, right? So it grows because you have more usage and also pricing above inflation, right? So you earn the real rates of return that are quite attractive.
And the other thing that I would just note is when I look at an increase in adjusted EBITDA, obviously you've got your CapEx, but I take a look at what your debt profile looks like. So let's talk about your capital structure. You did see actually a meaningful change in your net debt during 2025, delevering pretty significantly. What is your intention with respect to overall corporate leverage?
Okay, well, corporate leverage, we basically have none. We have a net cash position, but we've been doing that just ahead of what is expected to be a lot of growth, right? So yes, we could end up having some leverage, always as a triple B solid investment grade. So we could add some, but only if we get these opportunities that we are bidding for. Otherwise, we shouldn't have leverage at the holding level.
Yeah.
Leverage is at the project development,
level.
at the project level.
Yeah, and sorry, and I should have said this, you have a net cash position, but in terms of the kind of leverage you see at the project level, what is typical for say, an airport or for a toll road?
Okay, what happens in toll roads is that we always aim for investment grade rating because that's where you get the bulk of the financing is muni bonds, you name them, or USPPs, whatever, and they are based on a triple B rating. So it's important that you have very long tenors and that you follow the cash generation of the project, right? So you end up adding some leverage that brings more dividends to the holding company a long time, but always with a triple B rating, triple B minus, but very solid investment grade rating in all our projects.
Can we talk a little bit about the performance of your share price and also talk about the decision to list in the US? Mm-hmm. IPO'd about 18 months ago on the Nasdaq.
Yeah.
Why? Why did you decide to do that?
Well, I think it's the natural thing to do because our value is in the US, our customers are in the US, and it's a natural thing to do to look for this. Also for our employees in the US, they want to have stock, right? And one of the ways to do that is to be listed here, right? So it's just natural. We have your shareholders, we are looking for more because the business and the value creation is here. So it's just a natural correlation. It makes a lot of sense.
And I'm curious, Ferrovial made the Nasdaq 100 in December. And people don't often talk about this, so I'd love to get your perspective. Yeah. What difference did entering that index make to your shareholder base?
Well, we have now US index trackers. In the past, we had either global or Europe index trackers, but not specific US index trackers. And that helps a lot liquidity, right? Because we have many investors that want to put big positions in the company, but they want to have increased liquidity. And this is key to have access to indices. It just helps that.
And so when you think about you're in New York now, you're meeting with lots of investors. Which kinds of investors are finding themselves most drawn to your stock? Are you seeing a lot of interest from more institutions like pensions, given the long-term nature of your contract base? Are retail investors becoming a bigger part of your shareholder base?
I would say to all of them is a good answer, right? Because we have a business that is needed, that can price, let's say, in real terms, with real term increases, and it has duration, right? So pension funds love it. Insurance companies also own that. Family offices, because you have this, let's say, compounding effect that adds value, but also dividends, right? So it's a nice combination. But it all boils down to the great product that we have, right? That is something that is needed and helps people to really travel in these areas.
So you said something, it was almost a throwaway comment, Ernesto, which is you'd like to have more US investors. How much are you finding investors raise their hand and say, well, first of all, why are you still reporting in euro?
Okay.
So let's go there. And then second of all, how are you trying to get the message out there to, US shareholders?
Okay, well, the message to your shareholders, I guess it's more easily viewed than explained, right? You have a video of any of the assets in Dallas-Fort Worth or in Toronto, and you see how people appreciate using it, right? Because it's very convenient. You're in a traffic jam, you can jump into the express lane, let's say, or in airports you also view that, right? So, speaking to any of the users, they're likely to become shareholders, right? That's the way we explain it.
I have an out of left field last question for you, just because you're in such a unique position to see this. The technology of travel is changing. Right. And I remember, I'll give you an example. In private equity, I was looking at investing in a car parking company. Yeah. And we had to do all this diligence to try and figure out if there was going to be a secular decline in the number of cars on the road because rideshare was growing. So when you're looking and scoping these projects, how much is it true? Do you think there is going to be a secular decline in cars? Or if you're building airports, things like the Jobies and the Aviations of the world are looking for new kinds of terminals, right, for their eVTOLs. Yeah. How much is that feeding into the design of the projects that you're seeing?
All this comes into play. I mean, I think that autonomous vehicles are going to be great for us. I mean, you think of autonomous vehicles as bringing down prices and making it more convenient. I mean, if you're a senior citizen, you can have a car coming to your door very cheap. You use that. So basically, you're substituting also public transportation with autonomous vehicles. So something that has a lower price means more demand for that, right? I mean, it's just cheaper, right? And there will be a time will be a little bit complex because human-driven and autonomous vehicles tend to bring more congestion. It's a little bit complicated. In the future, maybe you could use a little bit congestion when you have more than 80 or than 90% of autonomous vehicles, but they will travel very fast, very close, right? So it will take a leap of faith to do that. But I mean, definitely that's helping, right? So yeah, we're looking forward to that. Regarding eVTOLs could be good for some, let's say, short trips. And airports will have their own vertiports from people that jump out of a plane and get into a kind of sophisticated cab, right? But I mean, I don't see eVTOLs just crossing the Atlantic, right? So in that regard, JFK could have a good combination for both.
Hopefully they bring the Concorde back, though, so we can go transatlantic much faster. Ernesto López, Chief Financial Officer at Ferrovial. Thank you.
Thank you for having me. Thank you.
I'm Anne Berry. Thank you for tuning into After Earnings, the show that brings you up close and personal with the executives behind the world's most interesting publicly traded companies. If you learned something today, don't forget to like, subscribe, and share with your friends. Upcoming episodes will feature CEOs and CFOs from Booking Holdings, Duolingo, and many more.